Every healthcare owner dreams of owning their building because the real estate can be just as valuable as the practice itself. But there's a right way to do it, and there's a wrong way to do it that can cost you big. So in this episode, I'm joined by Brian Wine, a real estate expert who works exclusively with healthcare professionals. We're going to dive into what makes a good deal, how to negotiate leases like a pro, the strategies that smart owners are using to turn their property into a powerful long-term asset. So whether you're looking to buy your first building or make your current setup more profitable, this is a conversation you definitely don't want to miss. Practice owners, tired of working hard but not seeing the financial results you deserve? I'm Eric Miller, and my best-selling book, How to Become a Financial Beast, is your game changer. Learn how to maximize profits, pay yourself right, and build wealth outside your practice. Download now for free. Welcome back to the Financial Beast podcast. I am your host, Eric Miller, chief advisor and co-owner of Econologics Financial Advisors. We specialize in helping healthcare practice owners get their money right. We show you how to clean yourself up, how to set things up, and then how to grow up when it comes to your finances. And we've been doing that since 2008 for veterinarians, dentists, physical therapists, anyone that has a healthcare practice. We can certainly help. You guys can check us out at econologicsfinancialadvisors.com. You can go directly to our website. And as always, please, hit us up. Give me a like or a share if you like the episode. We're going to try to continue to bring on guests that we think are going to give us something valuable. Most of you got into the healthcare business because you wanted to help patients. But not many people that I know got into it because they wanted to become bazillionaires. I don't even know if that's a word now. But I think having money is definitely virtuous and righteous, and you guys all deserve to have a lot of money. So let's make sure that you're making right financial decisions. And speaking of that, we're going to talk about real estate, because who doesn't like to talk about real estate? And to do that, I have brought on Brian Wine. Brian Wine is the founder of the Wine Group. They specialize in, make sure I got it right, practice sales, practice building sales, anything else?
That's really it. Those two, but in three niches today, or three verticals: vet, dental, and behavioral health. There will be more over time, but today, those are really the three bread and butters, you would say, for what we do.
Yep.
Yeah, practice sales and or building sales is really the key metric here. We can help in other ways as well.
Exactly. Now I met Brian. Actually, I've heard his name floating around quite a bit, just because we've been in these industries, and when someone uses someone for a transaction or for something, names get around. And I know that he's helped a number of our clients on the acquisition side of practice buildings with a lot of success. And that's, we want to kind of focus on that and talk a little bit about that, because I'm super interested in it. And I think other people are too. And with the number of people that are selling their practices, you have to find good investments out there. And, is this a good investment? Which actually is going to be my first question to you. Actually, it's going to be a little different than that, Brian. Why the hell are practice buildings such a good investment?
You guys, first and foremost, most of you following this are, your doctors. So you understand the actual business itself. You understand when a business is doing well or not in your given field. So let's just start there. You probably most likely know how these businesses run. So you kind of know, okay, when I walk into one of these facilities, I know it's either doing well or not just by looking at some of the key metrics, because you do this every day. And then when you get into the three verticals that I know today, obviously these other ones, there's still great opportunities as well. I just don't know them as well. Can't speak as well about them today. But I think, first off, you've got a build out that could cost anywhere from $250,000 to maybe $2 or $3 million, depending on what kind of facility you're looking at, size, all of those things. There's also, doctors, you have to go through school. So to have a doctor in your facility, it's not so simple. And, you have to recruit them. They're normally on contracts. On top of that, obviously I did say build out, but you look at the plumbing for a
Mm-hmm.
lot of these facilities, they're normally picked out certain ways. And then, you couple that with a really good tenant behind it if you're a corporate guarantee, or if you're, let's just say Joe and Sally's vet office, there's still an opportunity there too. There's a lot of different metrics to look at in order to, make sure you get this return, great investment for many years to come.
Yeah, for sure. I got interested in them just because I started seeing the the corporations and how they negotiated the lease agreements. And I don't know if they're still doing this now, but they were like doing like 20-year leases, 15-year leases with like, I think 5-year, renewable. Um, and I guess I always just had the idea like, my gosh, that you have a tenant in here for the next 15 years, with a pretty, I guess, solid financial background. I mean, what could go wrong? I'm sure things do, but it seems to me like a pretty. I mean, what's the risk of owning a building? Obviously, is you have a default risk, right? Is that your people don't pay?
It's that, or it's, some sort of landlord responsibility. Sometimes there are, you're responsible for roof, structure, HVAC,
Mm-hmm.
parking lot. A lot of doctors say they don't want to be hands on that way, but you could hire a management company or others to assist you. So I don't think it's that difficult. You shouldn't be scared of those obligations, let's call it. But, you mentioned default. Yes, you could be worried about that. But typically, if they have above 100 locations, for the most part, these groups are backed by private equity. Most of them are not failing. Some are today financially, but they're figuring out ways to get better and stronger to get out of that. Also, you mentioned the 20-year, 15-year long-term leases. Yeah, they're pretty much set. Today, we don't see as many of those unless you
Mm-hmm.
negotiate it up front. So it's really helpful to have a really awesome business broker on your side, which we also do. We understand both sides, the business and the real estate. And I think you got to be mindful going forward when you sell your business. Really be mindful if you're going to end up leasing the space back, because about 50 to 65% of owners own their real estate as well. So I would just be mindful of, hey, when I sell my business, let's make sure we have the right lease in place, which we help with that, while a lot of brokers do not. So I would just be mindful of those opportunities, make sure that you're in the right position, because if you get a 5-year lease versus a 10 or 15-year lease, that really does matter for your future and the long term owning that asset. And it could be generational wealth. I mean, you know better than anyone
Yeah.
how long term leases really can help.
So when you say the right lease, give me like what your ideal would be for the right lease then. Like what would that look like?
Again, every location's a little different, but let's
Yeah.
just say you live in a secondary market, not a top 10 MSA. You're not in the Beverly Hills or New York City, or let's call it Miami Beach. But if you're
Mm-hmm.
in these other markets where you're worried if the tenant leaves and you're worried that you can't release it to anyone else, I think having an optimal lease would be 10 plus years. So
Okay.
you get that long term stability. But on top of it, the less responsibilities you have as a landlord, the better. Because, going into this, you're always the tenant. Most doctors are, hey, I want to make my business, make it more friendly for my business. But in all actuality, you're kind of changing your mindset to, well, I'm selling my business now. Let's make sure I have the right lease in place, because I'm now only the landlord. So let's
Mm-hmm.
just be mindful of that. And again, less landlord responsibility. So that means have the tenant cover and be responsible for the roof replacement and or maintenance. That's a really big one, because roofs are typically, I don't know, smaller buildings anywhere from $20,000 all the way up to a couple $100,000 depending on the size or square footage of that building. But other things to really look at, and typically in vet, dental, and behavioral health, I'd say roof is really a landlord responsibility. The tenants try to push that on you because it's a big every 20, 30, 50-year expense, depending on what kind of roof you get. But then I would really look at your HVAC, I'd look at your parking lot, the structure around the building. Those are really the main pieces. Some of these groups will say, hey, you have a modified gross lease. There's all different types of leases. They'll say, hey, a lot of the corporates will come out and say, hey, you have a corporate lease. You have an absolute triple net lease. It's triple net. You have nothing to worry about. But what doctors don't notice is what's really in that fine print of landlord responsibilities. And that's something I think everyone should double check, triple check. If you have questions, ask us. That's really what we're here for.
Yeah. That's excellent. So, and continuing with that, what else would you like to see negotiated? Like, what about increases every year? Is that something that you typically will also?
You're spot on. Groups will either do a CPI increase, consumer price index increase, which a lot of groups are trying to shy away from now. And then I'd say 2.5% to 3% annually is really the benchmark to be at today. Some groups are trying to make a better, balance sheet or profit and loss for their companies. So they'll do 10, 15% every 5 years. But the goal is to stay away from this flat lease term, because if it's flat, meaning no increases year over year or over the initial term,
right,
there is less most likely interest from buyers if you decide to sell your asset. If you say, look, I don't want to sell, the good thing about that is, again, it's not as good, but the good thing is in the option period, hopefully there is some sort of increase in that option period to then sell you. But again, you then have to wait, and obviously costs, like we're seeing in the marketplace, are going up because of inflation. So you just gotta be cautious of all of that.
Why don't you think some of these groups are buying the real estate? It's just not part of their business model, and they don't care.
I think ultimately, you know as well as a lot of us do in the practice space, you make typically more money on your EBITDA, your net profit of the business. They're typically, if they're ran properly, let's call it probably low end 10 to 12%. But on the high end, I've seen a corporate practice, which I shouldn't know about, but I do. It was doing 36.1% EBITDA.
Yeah.
So those margins typically were really in the, let's call it the 15 to 25% margin for a lot of these practice owners. Really, it's the 18 to 20. It's really where a lot of doctors we know are. And I'd say, in real estate today, most of the deals, depending on location and responsibilities and who the tenant is, the credit of the tenant, most of these properties are trading anywhere from, let's call it in the medical space, anywhere from about 6.5% all the way up to, let's call it 10% returns. And so a lot of these groups realize, look, we could just go buy these businesses. Sure, the multiples are a bit higher, but then we get these higher returns and we don't really have to deal with the real estate. But some groups are looking at, hey, I see the opportunity. When I put my lease in place, we could make a couple $100,000 when we exit, or even more, depending again on the size, the location, all these metrics that I've just shared with you. So I think they see a bigger picture of, hey, I'd rather put money into these businesses. We're good at recruiting, even though it's really hard out there. They see just bigger multiples, and that's really what they want to specialize in and spend their time in.
Yeah. How do you get deals thrown your way?
I actually have a post today on LinkedIn about that. So
I didn't see that. So that was...
It's coming in a minute now. It's about where I started and what I did at the beginning of my career. It's about, everyone trying to build their own business from scratch. But back to that question of how do I get deals? Where do they come from? So there's a couple different areas. It's podcasts like this. It's great contacts and friends like you.
Mm-hmm.
And then I've cold called for 10 plus, 11 plus years now. So originally I cold called so much that I said to myself, look, I'm going to make 300 calls a week until it gets to a point where people are calling me left and right.
Yeah.
And obviously that kind of happened at year 2 or 3, where I got so many calls out that I was adding value every step of the way, where people now realize, okay, Brian's an expert at what he does, and I'd like to work with him. And funny enough, through cold calling, I met one of our mutual, clients,
Oh, no.
which is
Nice.
great. So
That was just a cold call, huh? Nice.
cold call, I believe led to that. Actually, really, I listed a deal. He may have reached out on one of my listings, and/or I called him because he's a doctor. We represent doctors, but conferences, calling, email outreach,
Yep.
mailers, social media, and then being friends with a lot of great people like yourself.
Nice. It's the only way to do it, man. It really is. And then there comes a point where it all pays you back, but you just never know when it's going to happen. I guess that's the grind.
It's the mystery of it all. But in the end, if you work hard and you put the time in and do the right thing each time, I think it all comes back to you and however it's supposed to come.
Are interest rates, what's that doing right now to the environment with the way the interest rates are right now?
It's tough out there today. Rates are, for real estate, investment real estate, I'd say it's anywhere from about a 6.5 to a 7.25 of a rate. But if you're a really good borrower, maybe you can get down to 6.25. I've seen as low as a 6.14%, for some
And
of
those
our
are
calls.
and those are usually like what's the term, what's the length of the term?
Actually, our mutual client, he just closed on a property. He, I think the real estate deal was, sorry, I'm thinking, I think it's 6.5 years remaining on the lease.
Mm-hmm.
There are some responsibilities, but this client of ours, he's done very well for himself. So I think he has a good amount of loans with this one particular bank. Originally, when we were under contract, I don't know, 8, 9 months ago, the rate was a 5.95. And over time, because the deal took a little longer, the rate had to adjust because of what's going on in the marketplace.
Right.
I'm not sure exact terms of what he got, but they were very good terms. I think it's like a 5-year amortized loan, at like 25-year amortization. But I don't want to promise those are the numbers. I would just, back to your question of, does it make a difference in the market? Yes. If you're really thinking about selling today, if you don't have to sell and you're willing to wait maybe a year or two, because we don't have a crystal ball, it could be worth that, because when rates start to come down, typically prices go back up. And so people can borrow more money.
Mm-hmm.
And borrower psychology is really, hey, if my rates are 7, I feel like I need a little bit of a return on my 7. So let's just call it, I need an 8% return, because my 7, again, this is back in the napkin math. It's not actually true, because it depends how much you put down and what the loan schedule is. But a lot of borrowers like, hey, I need a good bridge or delta between my interest rate and my return. So a lot of people,
I always looked at that as just like your cash on cash return, right? Because in most cases you are, at least when you're purchasing a building, maybe just for an investment purpose, maybe not for if you're gonna put a practice there yourself and run it. I think you can probably get by with less than a 20% down payment. But I think in most cases, is it still about 20% down right now that you're having to put?
on real estate, it's typically about 25% down.
25. Okay.
You just got to be careful, because if you over lever, and let's just say you put all your money into one basket, you could have an issue if the tenant has an issue. So look at, your lease term, all those sort of things. A lot of my clients who don't have as much, they do 25%, because then they can lever more and go into a bunch of deals at once.
Right.
It just depends how you cut it. If you're doing an owner user deal, meaning you're the doctor buying the real estate, you could probably get 10 to 20%. We recently did one in not too far from you in Fort Myers, where
Mhm.
I think she put down 20% because she was a new practice owner. So it was a little
Yep.
different metric, but she got an amazing rate. So it just depends. I think there's a lot of different deals. I'd say talk to people like us because we have relationships with banks. I'd also say we can introduce you to loan brokers who can make all these banks compete against one another so that you end up with the best deal. A lot of
Yeah.
people, oh, my banker
Oh my
gave me a
guy.
great deal. My
Yeah.
God.
Yeah.
And in all actuality, when they're not competing, they're not giving you the best deal. They just make you feel that way because it's about, let's call it service, but you really should make them compete because you just want to make sure that they're being honest, in my opinion.
Yeah. So going back to that cash on cash return, like I guess if I'm looking at something and I don't know if I have a target for what I'd like that to be, but I mean, let's just take like a $1 million practice building. Okay. So just to keep the math, I guess some semi simple. So then I'm going to be required, and let's just say it was 20% down. I know you said 25. Let's just say 20% down for easy math. Yeah, $200,000. So now, um, for you, what would a good cash on cash return look like for you to be interested in that deal?
So typically I don't buy deals because I don't want to compete with my clients, but let's just say I was interested
Yeah.
and I saw an opportunity and where I've seen my clients make a lot of money. So I came from another world where I worked at a bigger shop and now I have my own company. And at the bigger shop, they sell apartments, they sell it all, any
Mm-hmm.
asset class you could sell in. So I actually had an email come across my desk yesterday, beautiful 49 unit apartment building in Los Angeles, like near the stadium, the new Rams stadium. And
Yeah.
so for that kind of asset, they were saying, look, you get a 7% cash on cash return. And to me, for an asset in LA where it's a top 10 MSA and it's an apartment building, your returns are typically lower. So that deal to me was a great opportunity. But to me right now, I'd rather hold my cash and go get something with double digit returns because they're
Yeah.
out there. We're in a tougher market. So every asset class has its good returns and the value add. The higher those cash on cash returns are, typically a little more risk is what they
Yeah.
say. But I typically target, let's call it 10% returns or greater. But I like to diversify my portfolio. I mean, just as well as I do that if you put too much money into one asset type, what happens if it has a problem?
Yeah.
So I'm all about being conservative with myself and with my clients because again, if the client says, let's take a huge risk, let's go for this, sure. But the goal is really to build long-term wealth. It's go and invest in a lot of assets over time that aren't too risky, that compound to get us to where we want to go. Financial
Yeah.
freedom, call it.
Yeah, absolutely. And I think you're right. There is a risk, honestly, when you're dealing with a medical building, because I mean, actually there was a deal in Ohio near where I grew up, and I was like, oh my God, this is such a great building. It was a beautiful building. Um, I knew it had been a vet practice for a while in that area. I was like, man, if I can get this, maybe I can get this with my brother and my dad because it's close. My brother's like an HVAC guy; he can take care. I was thinking like all these things, and it got outbid, right? And someone else bought it, and I'll be damned. Like 2 years later, I got it. I was driving by the building and there was no sign out front. I was like, what happened? And I go on their website and they say, unfortunately, due to lack of being able to find vets, we had to close down. And I'm just thinking, oh, thank God.
thank God you didn't make that purchase. And just
Exactly.
for you guys watching, there are some ways to get out of it. So,
Hmm.
if that happened to you, and in this market, it's happening a lot more,
Yeah.
and I'm actually helping a lot of clients figure out ways to not fully lose it all. So there are ways. We can talk about them. I
Yeah,
actually,
definitely. So I'm sure that is I mean, I'm sure that's going to happen at some, I mean, that's going to be the risk, right? Is like, I start losing doctors, and again, I think this is all part of the evaluation process. When you're looking at a spot, you have to look at how long has this thing been around? Like, what is the likelihood that doctors are going to want to come to this area to work, you know? Uh, uh, and yeah, so the demographic of that is super important as part of the deal. Do you have a mix of young doctors and old doctors? I mean, now these are all questions I think you probably need to ask. But okay, so let's say that does happen. Like what options do you have to be able to
sure.
get out of that?
Yeah, I mean, it's a great question. And a lot of clients go through this every year. It really depends on if you have a lease or not. If you have, if you have a lease with a corporate tenant, depending on the lease term, there are ways to terminate the lease and maybe even collect money out of it. So that's one option. If it's a mom and pop tenant, meaning it's not a corporate entity that leases the space, it's a little harder, but maybe there's a former doctor working there that wants to own his own practice.
Hmm.
Maybe you go approach them. Yeah, it's hard to do and it's work, but having a vacant building sit for 6, maybe 12 months in this market's not worth that pain. I think it's better to start reacting and approaching these doctors in the area. If it was a vet space, maybe you Google around, hey, let's go call every veterinarian in this market and or
Yep.
because it already has the zoning permitting for that. But there's a lot of options. If you're going through this, we're here to help. But there's also leasing agents who this is if they're I would find the top 3 leasing agents in your given market and say, hey, I'm tasking you, interview all 3, see which one's the best fit, and then say, hey, you're going to go do this. Yeah, it could take a couple months, but it's worth not having a vacant building. And or after all of this, maybe you just decide, look, it's not worth the time and the risk and all of this. I'd rather just sell now, which we have a plastic surgeon who's selling his facility. So we work in real estate. We work in all the medical spaces. In
Hmm.
practice sales, we're more of the niches, but real estate wise, if this is occurring to you, we're always a phone call away.
Where's a lot of the activity at right now? Is it still in the veterinary space, in the dental space? Are you seeing like a lot of I think that's where a lot of consolidation is still occurring right now. So I'm assuming,
I mean,
that.
I think all medical has opportunity.
Mhm.
Everyone sees, hey, it's COVID proof. This is a service, not just a service. Our this is our life, like our bodies. And so people really care about health and wellness more than ever. I mean, even more than our parents' age.
Yeah.
So I think this is going to last forever. But yeah, I mean, the vet space for real estate and for practice sales is really it's going strong. It's not as strong as it was during the COVID years because money was so cheap. But
Mhm.
vet, dental, behavioral health, um, all these other verticals like you also do physical therapy.
Yeah.
I think there's opportunity in all of it because now more than ever, people really care about their well-being and more importantly, their dogs or cats or their animals. I mean, Mr. Fluffy, they love Fluffy. So
They do love Fluffy, and they'll spend $3,000 to make sure Mr. Fluffy is taken care of, which is great.
oh,
It's
I know our wives. I know my wife. Yeah,
it's true.
she's spending it.
It's true. It's true. Um, when would you recommend someone sell their building, or would you? I mean, and I say that just because I think the building for a lot of people is going to be a very viable long-term investment. income stream for them. I mean, when you do the math on it, it's like you're never going to make as much from the building by selling it than you will just by getting the, especially if you have decent lease terms. I mean, you're always going, but I mean, I guess there is at some point in time, it's like, I don't really want to do this anymore, and maybe that's just when they get to that point, I don't want to take care of the building anymore.
It depends on the person. Everyone's got different goals in life and a different journey.
Yeah.
I personally think you should never sell. I shouldn't say that out loud because I'm a broker and that's how we make our money. But I actually tell clients that tell them, do not sell your property.
Yeah.
All the time. And that's really how you create generational wealth. My father, big shopping center developer, he doesn't sell any assets.
Ever.
Unless it's a huge problem that it's too hard to manage. He's maybe sold one property of however he owns. And so I take that back to, you look at all the great, these generational powers that own real estate today, they don't typically sell unless there's a greater advantage, meaning you sell and the property appreciated so much, or you manage it so well that you can convert it and move up the rankings by doing a 1031 tax deferred exchange. That's an IRS tax code where you don't pay taxes on your gains if you trade into another property within a certain amount of time. So you get to identify 3 properties within 45 days from when you sold your property.
Mm-hmm.
And then you have to buy one of those 3 properties within 180 days from when you sold that property. So if you do these 1031 exchanges, you won't have any capital gains tax. And there are ways to level up. I have a lot of younger clients who they don't have a lot of wealth.
Right.
So they take this big chunk and they say, hey, I'm going to go buy this. And then in 2 to 3 years, hey, we've pushed the value here, meaning we either increase rents or in most of the doctor scenarios, it's a freestanding single tenant building. And so let's just say you signed up right when you sold your business, you sold and you had a 10-year lease. You could get 2 increases and we could be next year in the best market we've seen since 2021. And technically you could sell and maybe make an additional $200,000 to $300,000 and then trade that into another property and lever more. And
mm-hmm.
if you do this enough, you could end up with a $10 million deal when you started with $1 million deal.
Yeah.
And so the return on 10 at 8% versus 1, it goes up 10 times. So there's a lot of strategy here. Back to your question, when is it right? I mean, it really comes down to what is best for you and your family.
Yeah.
It makes sense. And there's a lot of heartache with that issue. And I don't want to own it and I want to travel or whatever it may be, then great. If it's, hey, my lease is coming due and I don't think they're renewing, maybe that's another reason. I mean, again, every situation's different. It just got to make sense for you. But again, talking to the right expert, I think it can really multiply here and really help you grow. Because if you talk to the wrong expert and they say, just sell, 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 they don't really have your best interest at heart. What if you could just rearrange the lease to hold it another 2 to 3 years to make another 2 to 500,000? I mean,
yeah,
every scenario is different.
Who is buying a lot of these medical buildings? I know you probably can't give up names and everything like that, but is it mostly private investors or is it institutions or is it a combination? Because everyone's trying to chase yield, right? Especially in a world where interest rates were lower, where you couldn't get anything just sitting. At least you can get 4 or 5% sitting in treasuries right now. But who is buying a lot of these medical buildings?
Every client of mine says, "Who are you selling this to?" So it's a great question. You bring that up. They're REITs, real estate investment trusts, who some are publicly traded, some are privately traded or not private. And then there's private doctors. There's apartment owners that sold their apartment, doesn't want to deal with, my tenant told me about the leaky leaking toilet. A
Yeah.
lot of those trade buyers come out and they pay more for your properties. There's a lot of these doctors who sold private equity. They see this opportunity.
Yep.
There's just random individuals out there who say, I want to own this type of stuff because of some of the items we mentioned about people really care about their pets and themselves. So they see there isn't that much risk. I mean, it's really, there's a bunch of different types of people.
Yeah.
But I think something else to note is a lot of these direct buyers that are, they specialize in whatever your niche is today and they buy that asset class. They typically do not pay as much money as these private doctors that we work with. And so I would just be careful, again, as an owner. If I was the owner watching, hey, yes, I have this direct buyer who really wants my property, but if they're not competing with anyone else, just like the banker, they might not be paying you the most. And typically, most of the doctors we talk to, they get one shot at this.
Mm-hmm.
This is the only shot. You don't build typically multiple businesses at once. Normally, it's you have one or two clinics, and this is really it. So, yeah, you could like the guy, but there could be on the other side of this another 50 to 500,000, maybe even more. So I'd say no matter who you speak to, always talk to everyone, because if you can make people compete, they typically pay more, even with broker fees.
Yes.
People always say like, hey, Eric, but you have a fee. Yeah, but with my fee, I can make them all compete. And that's just that little fee probably still pushes it further so that you, the owner, make more. So I think it just depends on case by case scenarios or circumstances. But
And then just last question on that. Are you seeing just more 100% cash deals, or I guess, maybe 1031 exchanges where they're just buying everything, or is there still a mixture of that and leverage at this point, even though interest rates are a little bit higher?
it's a mixture. I mean, I'd say there's less exchange buyers today because the rates are higher. So when rates are higher, typically people are, especially in this market, people are a little nervous, second guessing things.
Mm-hmm.
So with the rates being higher, there's less transaction volume. And when there's less transaction volume, typically there's less 1031 exchange buyers. Exchange buyers don't want to pay that capital gains tax. Obviously, federal level, state level, they're different. You got to talk to your CPA, accountant, and/or I guess your best friend ChatGPT and Google.
Of course.
But I'd say, the exchanges are probably down a little bit. People are loaning if they are getting a new loan, depending on if the circumstance makes sense or that deal makes sense. And then there's still a good amount of guys with cash on the sidelines who maybe they sold to private equity, they work with you. It's a mixture of both overall.
Yeah. Okay. Good to know. Cool, man. Well, hey, look, we hit a lot of topics. I really appreciate all the insight that you gave. It was really, really, really good. Thank you. How do people get a hold of you?
You
How
can
can they
call
connect
me.
with you?
My phone number is 323-609-4405, or you can check me out on Google, Brian, last name's Wine, just like the drink. And then, we help practice advisory and real estate sales. You can check out the Wine Group RE or ewgpa.com. And you can check me out on LinkedIn. I mean, there's a lot of different ways where they can contact you, but I'm here to help and, ask me any questions. There's no stupid question. We're here to help you doctors get to wherever that goal is in both your practice and or real estate, long term and or short term. So we're here for you guys.
Excellent. All right. Well, thanks so much, Brian.
Thank you again for having me. Take care.